Watching the housing market from the sidelines often feels like standing on the bank of a fast-moving river. You see wealth flowing past you, but it feels completely out of reach. Renting is pure consumption. Every month, you trade capital for 30 days of shelter, a transaction that creates zero long-term value for you. Strategic ownership changes the math by introducing leverage. It's the primary mechanism for first-time wealth creation. To see the difference, look at how $20,000 performs in two different environments. In the stock market, you earn returns on exactly $20,000. In real estate, that same cash controls a $300,000 asset. If the market grows by a modest 4%, your index fund earns $800. But 4% growth on the real estate asset creates $12,000 in equity, a 60% return on your initial cash investment. You can accelerate this growth using the 13th payment strategy. Making one extra principal payment every year shaves years off a 30-year mortgage and avoids tens of thousands in interest. Most capable earners never access this wealth-building engine. They disqualify themselves before they even look at the numbers, usually based on bad assumptions. The actual barrier to entry isn't a lack of savings, it is a lack of strategic financial planning. The most damaging assumption in real estate is that you need a massive amount of cash to start. The 20% down payment is a myth that keeps stable W-2 earners trapped in the rental cycle. We have to separate the two metrics. Your down payment is only one part of your total cash to close, which is the actual number you need on closing day. Cash to close includes the down payment, but it also accounts for prepaid property taxes, homeowners insurance, and emergency reserves. To carry the home safely, you must calculate your full monthly obligation, a formula known as PITI. This tower shows where your money actually goes. Principal and interest are only the base. Taxes, insurance, HOA fees, and mortgage insurance stack on top to create your true monthly cost. A lower purchase price does not always mean a lower payment. If property taxes or insurance premiums spike in a specific neighborhood, an affordable house can become more expensive to own than one with a higher list price. Focusing on the list price is a trap. Real affordability is found by calculating the exact cash needed to close and the comprehensive monthly carrying cost. Real estate strategy changes pocket by pocket. The financing that works in one zone may be completely different in another. The first tool in the planning toolkit is a government-backed low down payment loan. The FHA loan is built for flexibility, allowing qualified buyers to enter the market with as little as 3.5% down. When you move from a 20% requirement to 3.5%, the upfront cash needed to buy shrinks drastically. There is a trade-off. You must pay a monthly mortgage insurance premium. This insurance exists to protect the lender against default. It does not protect you. An FHA loan is a temporary bridge. It gets you into the home today so you can refinance into a different structure later. Monthly mortgage insurance is a strategic sacrifice. It allows you to stop paying a landlord and start capturing appreciation in your own name. For many buyers, even a low down payment still leaves a gap in the budget. Bridging that distance requires a more localized approach. The SHIP program is a specialized grant designed to cover the remaining cash needs for working families. This is a high-leverage tool. If you fall under specific income caps, it can provide $25,000 to $40,000 in forgivable funds to help you close. SHIP sits in the high-reward, high-effort quadrant. It is an effective tool, but it is not passive. Other people's money comes with other people's rules. You must meet strict income caps, buy in specific jurisdictions, and clear safety inspections. The compliance requirements are rigorous. Homes with deferred maintenance or major repair needs are usually disqualified. These grants are not handouts. They are earned through strict property selection and professional planning. When you finally find a property, remember that an offer is more than just a purchase price. It is a structure. Seller credits are a critical lever for protecting your liquid cash during a negotiation. Most buyers focus solely on lowering the purchase price. They completely miss the opportunity to have the seller pay for their closing costs. The math favors the credit. A $10,000 price cut saves maybe $60 a month, but a $10,000 seller credit wipes out massive upfront cash. You can even use those credits to buy down your interest rate, lowering your monthly payment far more effectively. A transactional buyer negotiates for a lower sticker price. A strategic owner engineers the offer to eliminate the cash-to-close barrier. This process takes place in an environment where proof outweighs feelings. Think of your mortgage planner as an attorney and the underwriter as the jury. Underwriters do not approve loans based on potential. They require cleanly prepared documentary evidence of your income, your assets, and your identity. You must define your financial buy box mathematically before you ever start browsing homes online. Emotional shopping without a verified blueprint is what leads to collapsed deals and lost deposits. Real Estate Launchpad ensures you are prepared before you enter the market. By slowing down to plan, you ensure that when the market speeds up, you're moving with a strategy.